Thanks for joining me today on our first Thursday. And this webinar is Funding an Asset Protection Plan. And this was Kitty, the affiliate attorney manager, her idea because she is very involved in the funding. And it's really a great way, it's a great approach to actually seeing how a plan works, to look at the funding. So this is going to be great. I'm looking forward to it. So let's get started. Of course, who am I? My name is Douglas Lodmell. I'm the co-founder and managing partner of Lodmell & Lodmell, the nation's #1 asset protection law firm. And we are also the developers of the Bridge Trust, which is really the breakthrough concept which combines the best of the domestic asset protection trusts with the best of the offshore asset protection trusts. If you haven't heard the webinar on that, does asset protection really work? I suggest that you go to lodmellpartners.com right now, go to the resource tab and view that webinar because it does explain why that's true. So today, really there's two things when you're talking about funding a plan that we need to consider. The first is the legal tools that we're going to use for the particular client. And then the second is the assets, of course. So how does this work? Well, let's lay out the legal tools again, just so we have them all on the table. Limited liability company, asset management limited partnership, and of course the bridge trust. So this slide is familiar to you, I think. This is where we put it together. So in the center, we have our asset management limited partnership. We have our LLC. We have our bridge trust. And then, of course, we still have the family revocable living trust. So as you may remember from other webinars, the LLCs are owned by the limited partnership. And the limited partnership also owns cash, stocks, bonds, and securities. And then we have those two events, right? One of which is going to occur. Either the client is going to die, in which case the assets are going to pass through to the revocable living trust, or we're going to have a crisis, in which case it's going to go to the secure bridge trust. And then, of course, client's still going to die. It's still going to pass through the terms of the living trust. So I just wanted to put this slide back up here on the table so that we can refer to it and remember it as we go through the funding, because this is really where the rubber meets the road. Okay, so let's talk about assets. There's two classes of asset. There's risky assets and there's safe assets or non-risky assets. And this makes a big difference because the fundamental rule of asset protection is don't mix them. Don't put risky assets with safe assets. So you wouldn't want to put your office building in with your stock account, right? Because the office building has a problem, burns down, a bunch of people die. Then inside that same LLC is sitting your $1 million stock account. It's available. It's completely available to satisfy a creditor. And so we are dividing up risky and non-risky. So let's talk about the risky assets. What are they? Well, real property is a risky asset. Boats, airplanes, cars, risky asset. Businesses, of course, are risky assets. Joint ventures, partnerships, investments, all those types of things are risky ventures. They can get you in trouble. If it has an engine, a motor, a door, a key, a lock, if it has customers, patients, clients, employees, partners, any of those things, those are where lawsuits come from. And as attorneys, we know that. We see them. Those are the points at which we see the biggest issues. So let's start with real property. So here we have an office building. Where's it going to go? Well, if it's that office building, it's definitely going in its own LLC. Definitely, right in its own box, right? And a separate one. We're not going to mix that in with another office building that size. What about a rental house? This is your little rental house in the neighborhood you rent out and you make some income. Well, it deserves an LLC as well. If you had 2 or 3 of those little rental houses, and maybe you had, $75,000 to $100,000 of equity in 3 different rental houses, you might put all 3 together for the client. And that makes sense. We're not overloading the LLC, and we're not too worried about the inside liability, the insurable stuff. We're mostly worried about the outside liability, which is, the client has a trouble and gets sued by a partner, and then they're looking for his assets. And in that case, the outside liability case, having an LLC with more than one asset in it is fine because we still have the protection. It's the inside liability that we don't want to overload one LLC with too many assets. Some of you might ask, what's the number? I like about $500,000. That seems to be a good number. Now, if you have, like in the example of that first office building there, a $6 million office building, well, obviously, it's in one LLC. But when you have smaller assets, I think you can break it up and kind of figure somewhere around $500,000 is a good mark to say if we've exceeded that, and then we should consider starting another LLC. All right. What about your vacation home in the beach there with your boat sitting out front? Where should that go? It's also most likely going to go into an LLC. And again, especially if you rent it out, especially if there's any type of risk associated with it, because it's it's used by other people, etc. I like to have it in its own LLC. There are exceptions to that, as there are exceptions to everything. So you all know there's always the exception. So, but in general, this is the rule. Okay, what about your airplane or your boat or your jet skis or any of those kind of things? So I've got an airplane up here. Where's that going to go? That definitely gets its own LLC, right? So in this case, with this example, we've got 4 LLCs for these various properties. Now the biggie, your primary residence. Where does this go? The logic of the arguments that we've already been talking about would say, well, let's put it in the LLC. But there's a problem with that. And the problem is that your primary residence has a couple of benefits that we really don't want to jeopardize. One is the tax-free capital gain when the client sells the real estate. That's a gimme. That's a freebie. I mean, we really don't want to mess that up for a client. And that's $500,000 for a married couple. The second is home mortgage interest deduction. So, if the client still has a mortgage on their house, the last thing we want to do is turn, a free deduction into a business deduction. There is an argument, and I've talked to attorneys and affiliates that have done the research and say, well, in my state and in my situation, I think that we can still retain those benefits and put the property in an LLC. And that may be true. But if you're going to do that, it's going to be a single member LLC or just the two husband and wife LLC. And so it's still not ideal. And it definitely shouldn't then be in the limited partnership, because then I think you do lose the benefits. So with the primary residence, we're going to do something different. It has its own considerations. So here's the way I look at it. If the home is in a state with a really good homestead exemption, an unlimited exemption like Texas or Florida, or if there's another compelling reason not to change it, for example, like in the case that only one of the spouses is doing the planning, but the home is in both spouses' name, or they're in a tenancy by entirety state and the home is already titled in tenancy by the entirety, and there's not a lot of equity in the home, then I would consider keeping the home in the client's name. And I know this is a little counterintuitive, but believe me, after working with a lot of clients, sometimes the home is a touchy subject, and there are times when the clients just feel comfortable, or one of the spouses feels more comfortable if they can see their name on the title. So with the home, I am very much aware of that, and I really help to adjust the planning to fit the need. The other way we can see the home is if the home is not well protected by state law, has significant equity, then we really want to consider putting the home directly into the bridge trust. And this is really an easy thing to do because the bridge trust is a grantor trust. So from tax perspective, it's not a separate entity. It doesn't have its own tax ID number. You definitely do not jeopardize the home mortgage interest deduction. You do not jeopardize the tax-free capital gain. And in fact, under Garn-St-Germain, putting a home into the bridge trust doesn't even trigger the mortgage due on sale clause. So this is where the home for my clients planning most often ends up, is in the bridge trust. Okay, let's move on to businesses. Here's a business. This is a great business, by the way. Cedar HR Solutions. They do custom handbooks and HR outsourced solutions for medical practices. Where are we going to put this if the client is the owner of this? Well, again, there's two options. If the business is risky, which most are, then we do not put it in the limited partnership. Well, first of all, I think it goes without saying the business goes into an LLC. I mean, that's the first thing. It needs to have its own LLC. It should not be a sole proprietorship. We do not do that anymore. It could be an S corporation if the accountant is really particular about it and wants it in S corporation for the tax benefits of being able to pay a salary to the owner and then dividending out the rest of the income to help with the FICA and the FUTA taxes, the Social Security taxes. So I'm making the assumption that it is in either an LLC or a corporation, and if it's a corporation, it's probably an S corporation. But are we going to put that LLC inside of our limited partnership? That's where it depends. If it's risky, if it's a high risk business, you're doing something that has a high degree of visibility to the FTC, then we're probably not going to put that business into the limited partnership like we had on our slide. And instead, we focus on stripping the value out of the business. So that could include equipment, that could include intellectual property, it certainly could include cash and any other assets. And if there are things like intellectual property or equipment, we can have those in separate LLCs, which can be protected and can be owned by the limited partnership, and then leased back to the business. By the way, that's also a real positive tax play to have that happening that way. And definitely if you have intellectual property, you really want to consider that strategy because it's very good. The other option is if the business is not too risky, or if it has a significant asset which just can't be stripped out. It's just that inherent in the business. It's really that is the business is that there's this huge asset in there. For example, I have a client that the business basically is nothing but a collection of receivables for loans that have been made, and we're talking a sizable amount. It doesn't really do anything else. It's really just a portfolio of loans. You can't really strip the business, and frankly, that's not too risky. He's just collecting on loans. Then we take that business and put it into the limited partnership. Because again, remember, the limited partnership is owned by the bridge trust, so we have the protection. And I have on here a note that if the business is an S corporation, then if it needs to be protected, we can elect to have the bridge trust be a QSST trust, which that means qualified subchapter S trust, and it can hold S corp shares directly. So in the case where we have a client that walks in the door, he's got $5 million of those receivables sitting in an S corporation, and that's what his big asset, and he wants to protect it, and he's asking us, how do I protect it? That's where we would put those shares directly into the bridge trust and qualify the trust as a QSST trust. Okay, let's talk about safe assets. Safe assets go directly in the limited partnership. So what are safe assets? Well, cash, of course, right? So it's going to get its own slice of the LP pie. Stock, bonds, securities, those things. It's going to go straight in there and have its own slice of the limited partnership pie. Collectibles, jewelry, stamps, guitars, coins, whatever it is that's not risky but valuable can go and get its own slice of the limited partnership. All right, what about an annuity? An annuity can go in there. You do have to check with the annuity company, make sure that they allow for it, but that could go directly in the limited partnership. And what are these? Well, these are those 4 LLCs that we identified earlier, right? It has the office building, the rental home, the vacation home, and the airplane. Those LLCs go into the limited partnership. So it gets its own slice of pie. So at the end of the day, if you look at this client, that limited partnership is pretty much all his assets. That family is covered. The cash, the stocks, the bonds, the collectibles, the annuities, and all of those risky assets boxed first in their own LLCs, they're all in there. And this might be a good point to mention what doesn't go into the plan at all. What not to fund? Okay, in general, vehicles. Keep all the vehicles out I mean, I consider them maybe the riskiest thing most of my clients do is drive. Yes, they have insurance, but I have also seen insurance be inadequate. And so ironically, you got to remember, once we've done our planning, the client themselves becomes kind of the safest place to have a risky asset, because the client can never really not be at risk, right? Because they're driving the car, they're holding the drill if they're a dentist, they're holding the knife if they're a surgeon, they're making the call if they're the CEO. So they're always on the line. So in some sense, it makes sense to let them hold on to the riskiest assets like vehicles. There's an exception to this, of course, if you have a fleet of delivery trucks. Well, they need to be in their own LLC and properly leased back to the business with absolutely great insurance and so forth. So, the other thing about leaving a vehicle out is that, if you have absolutely everything in trust and there is no probate at all necessary, sounds like a good thing. And in general, it is a good thing. But my father taught me a trick when I first started practicing. He said, leave something out and probate it. Because when you probate even one car, you start the statute of limitations running on anyone who might have a claim against the estate. So probate something, anything, a car, a bank account, whatever. It can be very small. It can be something that doesn't put a damper on your lifestyle where you're going through it. But that's another reason why I kind of like cars out of it, because those are the things that we can probate. And life insurance, annuities, and IRAs. Those things are often not in the plan. Life insurance, of course, needs to be looked at individually. It may need to be in the limited partnership if it has big cash value. It may need to be in a life insurance trust if it's designed primarily for death benefit and to pay taxes. So I put it here because it needs to be looked at. In general, it's not something we automatically put into the asset protection plans. The third one is company draws, dividends, and receivables. Oftentimes those are things that need to stay in your name because of the way they're structured. Receivables, in general, would be part of the plan. So what we're talking about here is like special things like drip plans or things that are just restricted because of your employment or whatever. All right, let's talk about the bridge trust, because there's a couple of things that go in there directly. We already talked about. One was the primary residence, right? So that's going to go in there. And the other was all the things in the limited partnership, all those slices of pie that we just identified, because the bridge trust is the majority limited partner. So think of it as a circle that just kind of encapsulates all of those assets, the home directly, and then because it's the majority limited partner of the limited partnership, it pretty much owns all of the equity in all of those assets. And that's how it all fits together. So if we think back to that slide where we put it all together, that's the wrapper. That's why I put it into circles, because it really just does. It's like an umbrella that covers everything. So there's a few more assets. 529 plans. These plans are protected state by state. So it really depends. And so Florida, for example, does protect it. New York doesn't. But if you live in Florida and your plan is based in New York, you may get the protection. So you're going to have to look at that state by state and determine if your state is a good one or not. And if not, they could be put in the limited partnership, again, to add that protection around it. Okay, these are some questions that Kitty had identified as things that she's answers a lot. So I think this was a good time to go over them. So how to set up your limited partnership accounts. All right, if it's a new account, you want to choose a brokerage firm or a bank that can set up a business account in the name of your Arizona Limited Partnership using the tax ID number of the limited partnership. I recommend normally that the clients use a brokerage. Typically, we're not talking about your day-to-day money and spending that you're going to have in this limited partnership. You're talking about your long-term savings. And in general, a bank is not the ideal place because you want to make investments, and a brokerage account is really more set up to do that. So I typically recommend a brokerage account. Some clients ask, do I also need a bank account? And the answer is probably you do. A lot of brokerages accounts actually won't accept wires or funding unless it's coming from a bank account of the same name. You don't have to, though. But oftentimes I find that it makes sense to have a bank account and a brokerage account. If you're really into convenience, pick the same bank. I mean, you can use Wells Fargo Advisors and Wells Fargo, or you can use Merrill Lynch and Bank of America. That's up to the client, of course. And this is another really important point. Sometimes clients are very attached to their bank, to their financial advisor. Sometimes they're not. I consider our job not to disrupt their lives and try to convince them or provide too many options for them changing what's working for them. We're putting a legal wrapper around things. So I don't come in and say, well, really you should consider changing to this bank, to this broker, to this. Now, if the client asks me and says, look, I don't have a good money manager, I just never felt comfortable, and I'm sitting in cash and I don't know what to do. Of course, I'll give him a name of somebody that I think is good. But in general, my goal is to just provide them with the legal wrapper and the advice to get their current accounts structured properly. If it's an existing account, they're not going to be able to change the ownership. It sounds like you're changing the ownership, but in reality, you're setting up a new account, you're funding it, at the same institution, you're funding it, and then the old account can stay alive or can be closed. I don't know of any bank or brokerage that will change the name on an account. They just simply open a new account. Okay. What are the tax consequences of asset protection? Well, it's really important to understand this, and we have a tax opinion letter that all of our clients get. If anyone wants to see that, just email Kitty, and she'll shoot you a copy of it as a sample copy. But the bridge trust is a grantor trust under the IRS grantor trust rules. This means that it is really invisible from a tax perspective. It doesn't have its own tax identity. Which means, again, the client is the one who is seen as the taxpayer. Combine that with a limited partnership, which is also a pass-through tax entity. So the limited partnership files a 1065 return, which is informational, right, to the IRS. It's a federal informational return, and then kicks off a K-1 to the grantor trust, which is really the client's. And what you have is that the net effect is that your asset protection plan is completely tax neutral. I can't tell you what a big deal this is. One, it's great for the accountants. They get this. I mean, in 2 minutes, they understand exactly what we're talking about and they appreciate it. They want it. Two, it sets us apart from those people that are providing poor tax advice and abusive tax advice. And there used to be a lot of them. I think the crackdown happened, some people went to jail, and there's not as many. I don't hear this as much as I did 8 or 10 years ago, but they're still out there, and you still run across it once in a while. There are people that are using the moniker of asset protection really to sell an abusive tax structure. That's really what they're doing, but they call it asset protection. They're saying in effect, oh yeah, this is asset protection. It's not. And so really the general rule is you should not combine your asset protection plan with a tax plan. A clever accountant is going to see places in your asset protection plan which will provide for some opportunities to take deductions. That's just fine, nothing wrong with that. And there's also opportunities to make estate planning transfers, like giving shares of the limited partnership to your children. If you have a big estate, it could be even at a discounted value. So your limited partnership can be used for that. But in general, the rule is asset protection and tax planning don't go together. And I think if you kind of have that as your mantra, it helps. Helps you with the CPAs, puts them at ease right away, and certainly helps distinguish you from people who are really abusing asset protection, or the word. I should say they're not even abusing real asset protection. They're abusing the word by just attaching it to their abusive tax planning structures. Okay, what about my existing estate planning? This is also a really important point, and it's a distinguisher between the way the bridge trust works and the way that virtually all of the other domestic asset protection and international asset protection plans work. The bridge trust is designed to flow through your revocable living trust or your will at death. So the bridge trust is actually designed from the get-go to say at death of the settlers, look to the revocable living trust for distribution directions or the will. And that way, what we've done is we've taken the activity of regularly updating your revocable living trust and your will and all of that, and we've kept it right where it is with you locally at the estate planning level. So it can be changed, it can be revoked, it can be moved, it can be adjusted, amended, all that they need. The bridge trust this whole time is staying there in a static phase, which is good. Your asset protection plan should not be moved and amended and changed all the time. It should be really stable. And by doing this, it allows for that. And it just makes it very easy. If a client comes in the door with a revocable living trust or a will, great. We can review it. We can make sure that it's good, but we don't have to address that as part of it. It also really segregates the decision. So some clients, if you go through the process of getting them to decide what they want for their revocable living trust just to do your asset protection, you're going to slow them down. It's actually a very big decision for them because they're thinking about guardians for their kids and who should get what. If you say, look, the asset protection trust can be completed and integrated, we don't have to address your revocable living trust right now. It makes it easier to click it in to an existing plan. If a client walks in the door and they need both, great. Well, then you collect all the information and you do both. So they end up with two trusts. But you don't have to. And it really is a big benefit when a client has just completed their estate planning with someone else and they walk in your door and you tell them you do have to do it all over again or you don't. And telling them that you don't is a lot easier. The clients can make direct distributions from the bridge trust, so they can have a directive saying at my death, peel off $100,000, give it to this person, and then the rest of it pass through my revocable living trust. Of course, that's possible. But the general rule is that the entire distribution will be done through the revocable living trust. All right, how do we actually manage? How do you coach clients to manage this? What to pay out of your personal accounts versus your limited partnership accounts? This is a question the clients ask all the time. So it's pretty obvious. I'm pretty sure everybody here would know the answer to this. But personal accounts should be personal stuff. So your house payment, your home insurance, your property taxes, your household items, expenses, utilities, groceries, gasoline, cash in your pocket, day-to-day expenses, just money to your kids, all of that stuff at personal accounts. So once you set up an asset protection plan, some clients ask me, okay, so should I close all my personal accounts? The answer is no, keep them open. You still need personal accounts. You still want to pay for gas. So it's just for personal money. They say, well, how much should I keep in there? And I say, well, it depends. If you spend $10,000 a month, well, then keep at least $10,000 in there. In other words, keep a month or 2 months worth in there. You don't want to ever bounce checks and run too low. But if you spend $10,000 a month, don't keep $100,000 in there. It doesn't make any sense. Now you've unnecessarily exposed that money. The Arizona Limited Partnership account, that's your long-term savings account. These are accounts that are set up like we talked about with a brokerage or with a bank, and that's where you're going to have your stocks and your bonds, and that you should not be using for your personal expenses. If you need to take money from your long-term savings to buy a personal expense, let's say a car, you need $25,000, you're going to go out and buy a car. You would take a distribution from your limited partnership, deposit it into your personal account, and then buy the car. So we just want to make sure the clients are aware on how to keep those things separate and keep it running, the accounting smooth. Once they get it and they understand how it works, it's really very easy for them to maintain, and it's pretty seamless. So congratulations, you have protected your assets. You've funded it. And thanks for joining me on this first Thursday. As always, give me a call, set up an appointment if you have a client that you want to do a joint analysis with. Otherwise, have a great week, have a great month, and we'll talk to you. See you next time.